Okay, well, my topic for the 5% bonus assignment on the final is number 3. The question is, how does the presence of information asymmetry impact accounting, considering the accounting information model that was first discussed early in the semester? So that model consisted of first economic reality, which was then captured by management, and management was then responsible for transforming that economic reality into information that was useful in the financial statements and disclosures, which would then ultimately be transferred to the users, who ideally would make informed investment decisions, as is part of the definition of financial reporting. So, with that, information asymmetry happens when the management kind of skips a step in that and takes the economic reality, the information from that, and reports it directly to the users. So in that, they're cheating some of the groups, and they might use it for their own gain, which would be like insider trading, things like that. So that's what information asymmetry is typically defined as. So with that, the way it impacts accounting is it causes the actual model I just described to not work effectively anymore. For example, the stock price of the company will eventually not accurately reflect the value of the company because of this erosion that's being created by this information asymmetry. So, just a couple of things I thought of that we've talked about since the midterm that I think are relevant to this discussion is, information asymmetry, I believe, is being created through, other avenues, or might possibly be being created through some of these other things I thought of. For one thing, measurement. We talked a lot about that since the midterm, and I think there's different approaches with that. So we've got like the balance sheet approach, where the um, it focuses on like the liabilities and the assets, or valuing them is the primary goal. So by doing that, is that the better way to do it? Is that decrease information asymmetry, or does it create more? But then we've got the income statement approach that focuses on revenues, expenses, and earnings, and determining those is the primary goal of that approach. So is that a better way to, provide information to the users and decrease information asymmetry, or is the opposite true? So I think those are some really interesting things that, aren't typically considered when we're considering information asymmetry or defining it. We've also got like the cash flow statement, where we've got the indirect method, the direct method. So which one is, really better? So we're really fixated on this, what is economic income. So are we, doing it justice? Are we providing users with, the real economic reality and information that's useful to them? So is the current system living up to that? Some of the issues I thought of. So thank you.